Welcome to the ProVest Pulse. I'm Gabe, he's Noel, and wow, Noel, it's been a great couple of weeks.
Mark has been doing well. We've been doing well. It's really been a good time here at ProVest. I'm looking forward to the information that we're going to be sharing with the crowd. And
absolutely, a couple of topics beforehand that we're going to cover: the AI trade, Iran deal, macro outlook, and some defensive sector opportunities. I'm excited to talk a little bit about that. We are filming this on May 29th, 2026. Noel, this is right before you get to leave on vacation, so might have to do a ProVest Pulse without you next time, but we'll see. Depends if it's good enough information to talk about. This is going to be relatively quick, but a couple things I want to note. I usually have a family first section, but my family's been relatively quiet this week, so nothing super much to share there. So we're going to gloss over that this week, and hopefully I'll have something to share next week. I don't know if you have anything specific, Noel.
my family will not be joining me in Florida this time for the first time in many years. So my children won't. Of course, my wife will be there, and we've got some friends going. So it's still going to be a lot of fun, but this is going to be the first time in several years we've not been able to have our children with us.
Hopefully you get to actually have some alone time with your spouse, your lovely wife, and get to cool down for a little bit in Florida.
It's going to be good. Not, being able to buy two people's meals instead of 6 or 8 or 10.
Oh, that'll help the account for sure. Anyways, let's get down to business. So obviously the last couple of weeks have been great. We're on our 8th consecutive week of gains. We keep getting told the Iran deal is near. It seems more so now because Trump is talking about a $300 million or $300 billion investment. Obviously those are two different numbers, but that's a topic on discussion now. So it does seem a little more tangible this time. Only time will tell. The Shiller P is now, which, Noel, if you want to give the audience a very quick rundown of what the Shiller...
First of all, PE stands for price earnings ratio. And the price earnings ratio is nothing more than the ratio between the price of the stock and the earnings of that stock. For example, if a stock is selling for $10 a share and the stock is earning $1 per share, then that's a PE ratio of 10. If the stock goes up to $20 and it's still earning that dollar, it's a PE ratio of 20. So historically, the regular 12-month forward-looking PE ratio, usually around somewhere between 16 and 21, something like that. The Shiller PE ratio is usually a little bit higher because they look back 10 years and they say, what is the relative PE ratio over that 10-year period? Well, we've had some tremendous growth the last couple of years. And so the ratio now, when you compare it with what it was over the last 10 years, is pretty high. And so 42.5 means that over the last, from what we are now, what the particular company stock or the stock market has made over the last 10 years, the stock is 42.5 times higher than it was back then.
Yeah. So we'll talk a little bit more about the Shiller PE in the next slide, but obviously we wanted something to highlight. A couple of key developments this week if y'all want to read those. So yeah, the Shiller PE, we are reaching levels that scarily mirror. I'm moving our camera down so you can see the picture, the graph that we have here is closely mirroring to what we saw in the 2000 tech bubble.
Yeah, right. And back then, when it reached 44, as you can see on the chart, it didn't stay there long. It fell quickly and it fell hard.
Yeah. So we're the equity risk premium, which just means the amount of risk you are taking from buying a stock rather than buying a bond, is getting closer to zero. It's near zero at this point. So there isn't a benefit compared to a lot of historical means. If you buy a stock and a bond right now, theoretically, you should have equal returns from both. So that's something we're keeping a very close eye on. Buffett already said, be fearful when others are greedy. And right now, people are getting greedy. Retail is buying options like crazy. hedge funds and all the other money managers out there are fully invested in the market, and sometimes right now even levered in the market. So at this point, we're the second highest we have been since 2000. So me and Noel are leaning up in our chairs a little bit, keeping a very close eye on where this is going. So something to keep aware of. Something we want to highlight alone, if you're familiar with the AI trade, the semiconductor industry, which is the chips they put in with AIs, that sector alone is now 22% of the S&P 500, almost a quarter. So historically, I mean, that's close to being just flat out unsustainable. We're pricing in these companies we're pricing in that a company will have perfect earnings performance and estimates for the next 10 years, and we're willing to pay that price now. So you're paying a much higher premium, assuming this company is going to be doing fantastic and perfect things the next 10 years, which is a very long stretch to make. But anyway, something we wanted to point out to you guys. Obviously, another thing is the Iran deal and the macro ideas and the macro meaning behind that. If the Iran deal goes through, we'll hopefully see oil prices drop, as well as inflation expectations will start to fall, with yields pulling back across and getting back to normalized stances. We're hoping to see something at the beginning of next week. I've kept an eye on social media this Friday, but I haven't heard anything yet. Maybe when this video releases, we'll get a more compounded result, but at the time of recording, nothing is set in stone and it's still up in the air. So once this plays into effect, we've seen a lot of growth in the AI industry, specifically when this war was going on, because, and Noel, you can chime in if you feel like it's different, because when the war began, people thought inflation was going to get higher because oil prices are getting higher and everything is just going to become much, much more expensive. So consumer staples, cyclicals, financials took a massive hit, or at least some of them didn't take a hit. They just grow at a much slower pace compared to the tech trade, because everybody thought that when tech is going to be the only thing that's going to be producing the returns it should be compared to everything else. So it's a little bit of a funny thing to hear from a lot of people, but that's kind of what we're seeing in that aspect.
We've seen the market do this before. It anticipates what they think is going to happen simply because based on the war, but they've never seen anything really like this, because this president is a little different than most other presidents. Whether you like him or not, he conducts business a little differently.
Yeah. So as inflation expectations come down, semiconductor AI trade will probably see a little bit of a pullback. I mean, the valuations are getting really crazy. Anthropic is only making $90 billion compared to a $1 trillion valuation. So, I mean, it's getting a little crazy. But another keynote that I found interesting, that I thought people would find interesting, historically, when a new Fed chair comes into play, the average market downturn in the first 3 to 6 months of a new Fed chair is about 12 to 15%. That's data that's back from 1914.
What we're saying, Gabe, is that we just got a new Fed chair, Warsh, and he's taking the place of Powell. And so every time we've gotten a new Federal Reserve chair, the market over the first 3 to 6 months of his tenure, the market has gone down 12 to 15%. And we match that with a very, very high Shiller P ratio, right at the highest peak. And so what's the stock market trying to tell us, Gabe?
Yeah, it's a little, you're getting a little bit of a mirror of what is to come. We're keeping an eye on it. This whole point of this show is to keep our clients updated. This show is going to be specifically for clients, and we're not going to be releasing this on our website or the general public. This is going to be a show specifically for you guys, because this is becoming a little bit more alarming, and we're keeping a closer eye on this. Anyway, the rotation opportunity. So be greedy when others are, be greedy when others are fearful. Who is being fearful of what right now? In my humble opinion, defensive is a great opportunity. The defensive sector has gone from 35 to 16% of the S&P, the lowest since the 2000 tech peak. And you know what's funny? I'm reading another Warren Buffett book, And the media in the 2000s started to call Warren Buffett a hag and somebody who was out of practice because he was buying a bunch of defensive stocks, big brand name companies that are still around today. They're household names, but they're not the sexy thing that you're seeing with the dot-com bubble back in the 2000s. Everybody wanted internet stocks then. But he was buying these companies and people were like, well, he's not having the returns he should be. Warren Buffett's now a fad. Fast forward 2 years and he had 3 of the best performance years he's ever had as an investor during that time frame. And we are starting to see, I saw a headline literally today calling Warren Buffett, is Berkshire starting to lose their touch? And then I was like, oh, history is starting to rhyme a little bit. So a sector that is interesting to me in particular is healthcare, consumer staples, utilities, specifically healthcare, because its valuation has gone down so dramatically. And it's a little funny to think that people are casting healthcare aside when we have the largest demographic is becoming retirement age. Healthcare spend is only going up. God help you know what the healthcare costs. I know how much strain that causes, but it's something to keep an eye on. If people want to live a long life, healthcare is something that people have to buy. So something to look at.
Medicare is costing more. I've got a Medicare supplement policy that's costing more. I know my wife just went on Medicare, and while we're glad that we've got the Medicare and it's not costing us as much as it was when we had private health insurance, we do know that that's going up. And I'll tell you that even though I'm in relatively good health, I have more doctors than I've ever had. And so it's just a matter of, we've got this great big giant ostrich egg of a baby boom generation going through the snake of time. And and you can see it moving through, and people in my generation, they're starting to die off. They're starting to be a smaller and smaller portion of the population. But until they get that way, the mortality rates have increased. We're not dying as early as we used to, but the morbidity rates are still pretty high. So what we're doing, we're not getting sick and dying, we're getting sick and staying sick. Mm-hmm. And that's what happens with us a lot of time. And I'm one that believes that you eat right, you exercise, you do things, you get enough water during the day, you do the things that you need to do. And then hopefully nature, or when I believe God rewards you by giving you better health. And so it's important that we understand that. But a lot of people aren't going to take care of their health. Mm-hmm. And so healthcare is going to become a larger and larger piece of our of the economic pie, simply because so many people are not doing the necessary things to stay healthy.
Mm-hmm. It's more of it's not a preventative culture. It is I forget the term somebody used. We're steering away from a preventative culture of healthcare to, take your vitamins.
Basically a reactionary type thing.
Yes, it's reactionary because that's where the money is. And unfortunately, I'm praying that people start to wake up a little bit from this and, hey, Noel, this is a great opportunity to get some walking and standing desks. So wink. Anyways, so that's what we think is something to keep an eye on. My personal portfolio positioning. I know a lot of clients have heard me talk about my own portfolio. So there's a couple people out there that have agreed to be my guinea pigs for the new portfolio. Those who sat in with meetings with Noel knows that I'm starting a new portfolio. I want to make sure that this is bulletproof and this is worthy of clients' interactions. So this is only a very select few have access to this, but I want everybody to be up to date on my thought process and how I invest and how I decide things. So I'm going to give a quick rundown of what I'm doing right now. Noel, obviously you have your models and I'm up to date with those as well, but this is something that I just want to keep people updated about of how I think. So current posture, we're looking more into defensives and healthcare, keeping the equal weighted idea of the market. What I mean by that is we're looking into the things that are on discount right now. We're now steering away from anything shiny because everything that is tech-wise has gone parabolic, which just, we're there. It's off the charts right now, the growth, which is great to see in your accounts. But I've heard this tune played before. I've read and seen this tune before. And the song aims the same way every time. So I'm making some changes in that aspect. There is some hedges in place. We're looking for more bigger dividend plays, more consumer staple plays that will pay us a large check while we wait for this cycle to play out. These companies are the companies that I'm looking into and have money into aren't going anywhere because they make up 3 to 4 shelves in your local supermarket. I guarantee you, some of you, most of you, would have one of these companies in your house at some point. So looking into that. Noel, if you don't mind giving people some updates on the current models that you have, the moderate growth, things like that. How are those doing compared to everything else?
Our moderate account is growing quite nicely. It's up a pretty good bit this year, but not quite as much as the S&P 500. But it takes so much less risk than the S&P. It's taken half the risk of the S&P 500, so it's not really supposed to keep up. Our growth account it has a little less risk than the market overall, but it is performing better than the S&P 500 so far this year, doing extremely well. And then our aggressive portfolio, it is catching up, but it has, it's done well so far this year, but it's not doing as well as we had hoped it would. I know that our growth portfolio right now, the top 4 sectors, which is what it invests in, is they're investing in telecom, they're investing in energy, they're investing in basic materials like lumber, things like that, and they're investing in technology. I can see what we're looking at right now is looking at defensive stocks and healthcare. They're both sectors of the market. And I can see a point when we would switch to them, when they would become the better performing. But what you're doing right now is you're looking, Gabe, is you're looking on the contrarian way and say, okay, what's been down? Where is it? Why is it down? Why is it doing what it's doing? And now you're looking at you're looking down the road where our model looks for trends. And right now, those 4 sectors that I just mentioned, the telecom, energy, basic materials, and technology, they're still trending up. Mm-hmm. We just don't know how long that's going to be.
Right.
But once that trend tops and it starts down, then we will be out of those sectors.
Right. The main difference I will say is I run a very concentrated portfolio, about 8 to 12 specific securities that I've done extensive research on. And I hold those positions for, on average, 2 to 3 years. And then I look for doubles and triples and then rinse and repeat, because the same story has been playing out since I was 15 when I started learning this kind of skill. It's just, what story is the market telling right now? Where is the money being moved to? And what companies are performing the best they can silently compared to what's being talked about outside and what everybody's having the grand poobah party about, which is AI in this case. So, that's a little bit about what I'm doing compared to what you're doing, but love to talk more about it. So anyways, that's a little bit more of a shorter episode this week. Hopefully we will have, I'll probably make a episode 6 without Noel. So maybe look out for that episode. It's going to be a little scary not having Noel on my screen and in the other room while talking about this. But if more news and more information is out there that I want to make sure that you guys know about, then you will get that promptly from me. So anyways, just to summarize, valuations are really stretched right now, something me and Noel are keeping a very close eye about. The Iran deal, if it is solidified, will signal a rotation catalyst. Inflation expectations will fall. That means certain sectors will perform very well. Defensives right now are in a buying opportunity very similarly than to what we saw in the 2000 .com bubble. And right now, let's just stay diversified, stay patient. Compounding every, 15% a year doubles your money every 5 years. So the biggest threat to your wealth at the end of the day, and I want everybody to make sure that they know about this. I had a couple of conversations with people, friends, clients, about the recent IPOs that are going on out there. And so while the shiny objects are nice, and if you want to put a very small thing into it, the shiny objects are like alcohol to me. And what I mean by that is once you start, you're going to want more because you're going to start to feel good, and then you're going to start to feel like a genius. And at that point, you're sloshed. You don't know your own name. You're walking down an alley with your wallet lost. And that's something that I want to stay away from and stick to what I've been doing for the past decade. So that being said, everybody, thank you very much for tuning in to episode 5 of the ProVest Pulse. Noel, any signing off words?
No, it's just that that I am so happy that Gabriel put these numbers together, because it gives our clients a sort of an insight into what we're doing, what we're trying to accomplish with our portfolios and how they're working. And I'm happy to be able for us to be able to provide this for our clients, so you can see sort of what we're doing, get an idea of how we are working, and that we're trying to improve every single day.
Yep. And just for people who know, or just so people know about this episode will be exclusively for clients. The other way you can access this usually would be our website. We make sure that if people want to get to know a little bit about us, they can view the ProVest Pulse there. But this episode, we are not going to upload it to the website, because this is some information we just want our clients to know at the moment. So once you get this listed YouTube link, make sure that if you know somebody that wants to hear something about this, or if they want to be informed, share that link with them. Email me and Noel if you don't have the link. We'll be happy to share that with you. But this is something that we're going to be keeping on the down low, per se, because this is really, really important to us. So to make sure that you guys know what we're thinking about right now. And our ears are perked up. And we're doing a lot to make sure that your future is secured. With that being said, do me a favor, y'all. I know this is boring. I know that most of you, hopefully most of you are doing this, but take a look at the disclosures, take a quick read. All this opinion, not advice. Consult your local financial advisor or psychic or magic ball reader, whatever you prefer when getting financial advice. But thank y'all so much. It's been a pleasure. Noel, enjoy your vacation.
I love it. Bored to be back for the next pulse.
Yes. All right, y'all. Bye now.